Hello, everybody, and thank you for joining us for today's fall market update. Very excited to have Krystyne Manzer from RBC share some thoughts, insights, and wisdom, and some positivity today. It's been quite a year with markets and everything going on. So we're going to look back, shed some light on that, hopefully provide some clarity with regards to where we're going, how we're going to get out of this, and what the future has in store, or what's trending. So we're going to look at a lot of those important items today. So very excited to have our attendees joining us. I'll have a look and say hello as everybody joins today. So hi, Brian. Hello, Darren. Hi, Dave, Jess Bell, Romit, Tom. Expecting some more, but very excited to have you all. And thanks for sharing this lunch hour with us today. Few housekeeping notes. The washrooms are located. No, I'm just kidding. We're not at a wedding. So if you do have questions or Q&A, please feel free to pose the question. That's what we're here for. So if you can use the Q&A and chat function below, we will monitor that and we will send those to Krystyne throughout. We're going to keep compliance happy by showing the disclaimer slides. So if you'll indulge me for a few more seconds. Thanks, Leah, for having that up for us. But again, big thank you to RBC, to Joseph, to Krystyne, and the whole team for joining us today and taking the time to share what we're seeing on the investment side of things, and hopefully make the picture a little clearer for everybody without trying to predict what's going to happen. But thank you for that, and always appreciate the support on that front. Perfect. This is our team, and we've got a new member today. We'll have his picture up next. Darren Suklal is joining us. He did some tax work for us previously, so very excited to have him on the team taking over for Ose. So welcome, Darren. Welcome to a first official webinar. And if you do have questions, Darren, you're able to jump in as well. So, but otherwise, you know the team. This is us. I think we look a little bit older, but still quite as youthful. So that's what we will keep doing on a day-to-day. And then very excited. We're just going to give one more minute here, and then I will be passing it over to Krystyne. So welcome, Krystyne. Thanks for joining us.
Thanks for having me.
Where are the doggies today?
Thankfully downstairs.
Okay.
Thankfully out of the room. They shouldn't be interrupting, but it depends if someone comes to the door. We might hear them in the background. Hopefully they manage to stay asleep.
That's wonderful. Well, Krystyne, for our listeners, Krystyne's also part of the Golden Retriever fan club. We have one. She's got two. So they keep each other busy, but they also keep the house quite furry. So kudos to keeping the house clean. And it looks like the room is quite nice behind you. So well done.
Not easy.
Perfect. So with that, I'll pass it off to Krystyne. And Krystyne, maybe you can just give a quick intro. I know we've done one of these before, but just sharing what you're working on, how you work on the RBC team, how you work as part of the team there, and then we'll get started.
Great, thank you. So I'm part of Global Asset Management, RBC Global Asset Management, and my role is to represent our capital markets view, our economics view in front of private investors. So I spend quite a bit of my time researching, publishing articles, speaking with our portfolio managers and investment management team around how we're positioning our portfolios and what upcoming events and risks that are around how they may impact portfolios. So I've been with RBC GAM for about 13 years now, and I've been with RBC for actually 18 years now. It's certainly been an eventful year, that's for sure, and I'll take you through that. It looks like my slide sharing capabilities. Oh, perfect. Okay, so I'm just going to share my slide here. Hopefully you're able to see that okay now.
Looks good.
Yeah, looks great.
Great. Okay, so I titled the presentation "Unsettled Markets," and that's largely a feature of what we've seen and experienced, what you've all experienced this year, which is some of the additional volatility than we've seen in past years, and a lot of the uncertainty that's come with it. The way I really like to kick off these presentations and discussions is to take a look at what risks are out there. And I love these Google search trends. You can go into Google and you can say, how often are people worldwide searching for the word inflation or searching for the word recession? And what we can see is that recession, which is that dark blue line, and inflation, which is the light blue line there, the search topics have increased over the past year or so. Recession really peaked a couple of times in May, and then again later in the summer, and it's peaked. It's come up a little bit more recently, but certainly not quite as much as we've seen inflation being searched. So that really speaks to what people are thinking and what markets are thinking about right now. On the left-hand side here, I've listed a number of topics that markets are debating right now. So are we going to have a recession, or will we avoid a recession? If we do have a recession, how deep will that be? Will it actually get inflation under control? And not just under control, but how quickly will it normalize? How quickly will we see it move back to that 2 to 3% level that we've become a lot more comfortable with? Will employment hold in? There are some good reasons to believe that employment could be a bit stronger if we do end up in a recession versus previous recessions. And then last but not least, from a Canadian perspective, it's been a very, very long bull market for Canada's housing market. And certainly in the last couple of years, there's been rapid increase in prices. And the question then is, will Canada's housing market finally falter? We've seen a bit of weakness. How much weakness could we potentially expect to continue seeing? So getting back to where we really started with this, what I like to show is the GDP of the economy versus potential GDP. So the light blue line, that's real GDP. So that's the actual amount of output that's being created in an economy adjusted for inflation. And then potential real GDP, that's if the economy was moving at its full capacity or growing at its full capacity at all points in time, this is what GDP would potentially look like. And what you can see is that the recession that we experienced after COVID, so that big drop down that we had at the start of 2020, is very, very different than the experience that we had during the financial crisis, which is that sharper or less sharp drop, but very steep drop that we had in 2008, and the slow meandering back to potential. And the difference between the two has really been a function of just how quickly stimulus packages were delivered, just how quickly people were able to get back to work, how quickly functioning of markets were able to recover from the pandemic. And what we saw after the pandemic was we didn't just get back to potential real GDP, we actually went slightly above, which means that the economy was moving at a more accelerated pace. It was growing faster and working at overcapacity relative to what can sustainably be achieved in the economy. And when we tend to see that happen, what it leads to is an inflationary impulse. So we end up with a bit more inflation. And that's what we've seen and that's what kickstarted some of the inflation. But then we had the emergence of some supply chain issues. We had shipping issues. We had things like social distancing interfering with our ability to produce and ship goods. And that contributed to, again, a stronger rise in inflation. And then all of a sudden we had an additional surge as a result of Russia's invasion of Ukraine and the impact that had on commodity prices. So when you combine all of these forces, economies growing very, very fast, potentially faster than the economy can handle, supply chain shortages, shipping issues, and commodity shortages and restrictions, you end up in a situation where inflation has reached multi-decade highs we haven't seen since the 1970s, and highs, truthfully, that we hoped we would never have to see again. It was about a decade of very low and sluggish inflation, and central banks were very worried about that. And now all of a sudden that trend has reversed, and it's caused a bit more dislocation in the market, and that's been the source of the volatility that we've experienced this year. The interesting thing is, normally you can point to one or two factors that have created inflation. What we've started to see more recently, and the reason why central banks are getting more worried and markets are getting more worried, is because the inflation that we're seeing is a bit more broad-based. We're seeing it in a number of different areas: transportation, leisure activities, food, commodity prices. It's happening in a number of different areas. And as this chart shows you, about half of CPI components, so the different basket of goods that make up the inflation index, are growing at about 6% plus. So it's not just one area. It's not just commodity prices. It's not just food prices. It's in a lot of areas, and that's what central banks are so focused on right now. Central banks, like the Federal Reserve in the U.S., they have a dual mandate. So the Fed specifically, their dual mandate covers inflation, so making sure that price stability remains, and they're also focused on unemployment, making sure that we're at full employment in the economy. And if you look at the dark blue line, that's U.S. unemployment. And what you can see is that rapid bounce back from COVID. You can see the sharp spike that we had in 2020 has come off, and we're now almost at lows that we've seen in unemployment. From a Fed's perspective, that's great news because it means they can completely forget about the impact on employment right now. That doesn't need to be part of their mandate. They can purely focus on inflation, taming inflation, and getting it under control. I say that's good news from the Fed's perspective because it will allow them to be a bit more aggressive and focus on getting inflation under wraps, which is very important for a proper functioning of the economy. However, from a consumer perspective, from a market's perspective, again, it leads to more volatility because we haven't seen the Fed be as aggressive as they have been in recent years. If we think back to previous crises, it was very slow pace of rate hikes because inflation was so low, and they didn't want to quell this demand and this growth impetus that was existing in the economy. And this time, they're happy to quell that growth impetus that exists because, in their view, it is overinflated. So that's what we've been seeing. This is a chart that looks at the Federal Reserve, their tightening cycles from March 2022, which is when this cycle started, all the way back to 1983, and the number of basis points increases in interest rates in the overnight rate or Fed funds rate going back to 1983. And what you can see is that on the left-hand side, this March 22 bar, the Federal Reserve has been hiking at about 40 basis points per month. So it's almost half a percentage point increase per month in interest rates since March 2022. And you compare that to previous cycles, December 2015, that was the last Fed tightening cycle that we saw prior to this. It was about 6 basis points per month. So a very rapid pace, change of pace relative to what we're used to. The same thing if you look at June 2004, it was about 17 basis points. So not even a quarter of a percentage point per month back in the lead up to the financial crisis. And this has more than doubled that pace. So as I said, the Fed is being very aggressive at hiking rates. They want to make sure that inflation is getting under wraps and they're able to keep it under control. From a market perspective, we like to look at what the market thinks and whether the market suspects the Fed will be successful or whether inflation will come under control as easily. And if we look at this chart on the left-hand side, this is inflation expectations. The dark blue line is the 10-year expectations. The light blue line is the 2-year expectations. And what it is a measure of the market saying where I think inflation will be 2 years out, where I think inflation will be 10 years out. And what you can see is that the dark blue line, the 10-year expectations, they never really jumped all that much. Yes, they got slightly above 2%. They've got to about 2.75% at the peak later in the spring. But they've come down quite a bit, and the 10-year expectations are hovering around 2%. That tells us from a long-term perspective, the market thinks that inflation isn't going to be sticky. It's not going to stay at these very high levels that we've been experiencing. It should come back down to about that 2% level. When we look at the 2-year line, so that's the light blue line, you can see that at the same time as the 10-year expectations peaked out, the 2-year expectations really peaked out. In fact, they got closer to 5%. So again, this is the market saying, we think that inflation 2 years from now will be 5%. That was the expectation in the late spring, in and around the March, April timeframe. So the market was very, very worried about how sticky inflation was going to be and thought that it was going to persist for the next 2 years. And what we've seen is as the Fed has been aggressively tightening rates, those expectations for inflation have started to come down, and they're now sitting right in line with the 10-year expectations, right in and around that 2% level. So the market thinks the action that the Fed is taking and will continue to be taking, and including this afternoon, is going to be enough to tame inflation to get it back under control. And that, from our perspective, is a positive because, again, it ensures proper functioning of the market. And then we look at the chart on the right-hand side, and this is market expectations for rate hikes. So this is the market saying, this is how many rate hikes I think are going to be needed in future in order for inflation to get under control. And what we can see is that I included all the different lines from back in 2020 through 2021. You can see that those expectations were very quickly ratcheting higher. And then all of a sudden at the start of 2022, they jumped up quite substantially to where we are now in November 1st, 2022. And what this is saying is that over the next 6 months or so, the market is expecting that the Fed funds rate is going to increase from where it is right now, 3 to 3.25%, all the way up to a peak of about 5%. So still quite a number of rate hikes expected. But they think that something's going to happen. They think that something's going to, this activity that the Fed is undertaking is going to cause the market to, it's going to cause the economy to experience some breakdowns, and that some rate cuts will be necessary. So the expectation that the market is pricing in right now is very rapid increases in the Fed funds rate. Then all of a sudden, a little bit of leveling out for between 6 months and a year, and within a year, more rate cuts, and we'll get back down closer to that 3.25% level. So this is what the market is saying. They're basically implying that that there is a risk of recession, a heightened risk of recession, and that the Fed is being very aggressive, but it's aggressive to the point where it may cause something in the economy to break. And the Fed has already said, we're okay with that. We're comfortable with that. We need to do what it takes to break the back of inflation. The impact of all of this is it reverberates through the economy in a lot of different ways. In the U.S., we've seen it occur in 30-year mortgage rates. So in 2020, 30-year mortgage rates hit a low of 2.85%, and just last week they hit 7.16%. So a very rapid jump in 30-year mortgage rates. And it's at the point where there's no real new originations in the U.S. So demand for 30-year mortgages in the U.S. is virtually zero at this point. The other place we've seen it closer to home has been in the Canadian housing market. So that same sort of rise in rates has led to a decrease in existing home sales, and it's led to decreases in Canadian home prices. Our expectation is this about a 10% drop that we've seen in Canadian home prices so far. Our expectation is that could end up being about 20 to 25% in a base case scenario, and that's a function of rising interest rates and declining affordability as a function of the changes in interest rates that we've seen in Canada. That's a Canadian average. If we think about the areas of the market that might be impacted more, the expectation is that the areas of the market that had the biggest run up during COVID are likely the ones that will see the biggest drop in this shakeoff. So some of the smaller Canadian markets, Toronto to some extent, major Canadian cities less so, about in line with the Canadian average. So that's our baseline expectation. I will note that that 20 to 25% drop actually doesn't even get us back to pre-COVID levels. So affordability, even in a situation where we see home prices adjust 20 to 25%, still doesn't look all that great. And that leaves us with a really wide range of scenarios around that base case. So we try not to pinpoint what exactly is going to happen, because at the end of the day, there's a lot more things that can happen than will happen. But we try to work in scenarios and think in terms of base case probabilities. What's the upside risk? What's the downside risk to that? And our downside risk is about a 40% hit to home prices. Again, quite drastic of an adjustment, and that's related to affordability. And the thing that apologies if you can hear my dog. That's a function of affordability being quite low, but also a function of buyer psychology. And what I mean by buyer psychology is we're interested and we're trying to watch and learn and get a gauge for how many people are sitting on the sidelines saying, yes, I can't wait for home prices to adjust 10%, 15%, 20% before I want to jump in and get that house that I've been hoping for. This is a bargain. Versus how many people are put off by the interest rates, or unable to afford houses, even with interest rates going higher, even though prices have adjusted, and are still going to sit on the sidelines for a while. So we haven't seen much data around buyer psychology. We think that that's going to be the main driver of what happens with home prices, in addition to different trends like immigration and obviously the supply shortages, inventory shortages that we generally have in the housing market. So what all of this means is that from a financial condition standpoint, conditions have gotten very, very tight for consumers. They were extraordinarily loose, and now they've tightened up. Part of that is housing prices. Part of that is the wealth effect that we've seen from the markets being so volatile this year. Part of it is the change in interest rates. There's a lot of different features that come into it. All that to say, financial conditions have tightened up. And what that means for markets is that we end up seeing a pretty big hit to confidence. And I want to walk you through this because this gives you a good gauge for how these sorts of events play out in the economy and the general path that we see them taking. So typically what happens is there's a hit to confidence. So consumer confidence is weak, business confidence gets weak. People are feeling less certain about their spending, their jobs, their general livelihood. And that plays out into intentions. All of a sudden you have consumers saying, that renovation I was going to undertake, that massive, putting on a new story of my house, for example, I don't think I'm going to do that. I'm going to wait a little bit and see what happens, and see what happens with my job, see what happens in the economy, see what happens with prices. It also plays through in business investment intentions. Businesses might say, that technology upgrade I was considering, that goes on hold for a little bit. It puts hiring intentions on hold to some extent. And that takes about 6 months to work through. And that's when you really start to see activity weaken. Consumer spending slows because people aren't buying the refrigerators, the durables that they were previously intending to buy. Hiring starts to slow down. It plays through to housing. Demand slows down and housing sales slow down. Inventories, there's a bit of a buildup, but companies are less inclined to build up their inventories as well. And that's how it feeds through into the economy, and you end up with a weakening economy. And what we've seen so far is that confidence is extremely weak. Intentions are weakening, and we're starting to see a slight impact on activity. And we expect that could really start to play out into the fourth quarter and into Q1 next year. So that's the general path of what we expect and how we expect this to translate into the economy. When it comes to our economic scenarios, I will say that at RBC GAM, our expectation is that we will end up in a recessionary environment, but that the most likely outcome is that as part of that recession, we end up with inflation normalizing and getting back down closer to that 2% level. So these are the scenarios that we like to put forward. Normalizing inflation, we put about an 80% chance on that. There's a 20% chance that we end up continuing growing, that perhaps the recession doesn't actually occur and we end up in this soft landing, which it happens very infrequently, but it can happen. There are a couple of things that could actually lead us along that path, but it requires a lot of things to go right all at the exact same time. We put about 60% odds that we end up in a recession with normalizing inflation, and about a 15% odds that we end up in a recession with high inflation. That would be a very painful scenario because we continue to see rates go higher even though we're in a recession. But we put the odds in general of a recession occurring at about 75 to 80%. We're adjusting those odds right now in some of our discussions, so sitting about closer to 80% now. And then a very slight, improbable but not impossible chance that persistently high inflation and growth. We think that's fairly unlikely because of how aggressive the Fed is being and how determined they are to quell inflation. So I mentioned that there are a couple of different things that we think could keep hiring holding in a little bit better, employment holding in a little bit better. And one of those things is hiring activity. So this is a study that was done by Goldman Sachs, and it basically looks at previous crises and what the impact has been on employment when activity has experienced a 1% shock. And it ranks this based on the gap in between how many people are looking for workers, so how much hiring there is, and how many workers are looking for jobs. And when that gap is really, really wide, when there are a lot of people looking for jobs and very few openings, what we see is that the slowdown in hiring tends to be a lot bigger, than it is when there are a lot of jobs open and not very many workers, more like the experience that we're seeing now. So what this says to us is, because there's such a shortage of workers right now, and hiring skilled employees has been very, very difficult, perhaps people will be less inclined, perhaps businesses will be less inclined to lay off the workers that they just work so hard to hire, and instead potentially just put some of their hiring plans on hold, as opposed to actually creating a cycle of rapidly rising unemployment rates, which we would typically see in these in recessionary environments or shocks to activity. So that's one of the things that we think could be a positive for the economy and could keep consumer spending buoyed a little bit more. The other part of this is that when we look at consumers, and I want to be careful with this because inflation is a consideration in all of this, is that consumers coming into this lead up to a recession are actually in a better position than we've typically seen them in the past. So each of these dark blue lines, these are the average amount of savings that households and businesses have, or income less spending that businesses and households have across a variety of developed nations. And then the dotted blue line, that's the median across all countries in previous to recessions. And what you can see is Canada, the fourth one from the right there, we have about double the amount of savings coming into this than we have had in previous lead-ups to recessions. And then you look at the US, and they have about 3 times the amount of savings that they typically would. So that says to us, consumers are in a fairly healthy position coming into this, which could keep consumer spending a little bit more buoyed. It could prevent a recession from getting too deep. However, there is a caveat to this, which is that inflation eats away at savings very, very rapidly, and the amount of inflation that we've seen can dig into this quite quickly and actually put us in a worse position. So I want to use this. I want to use this very carefully because a lot of it depends on how quickly inflation is able to get under wraps, and that impacts the depth of the recession. So shifting to the markets here, I don't need to tell you, it's been a really tough year for balanced investors. This is actually a ranking of returns since 1928 to year-to-date 2022, and it shows you what the average, what the balanced fund returns of a 60/40 portfolio have looked like in each calendar year dating back to 1928. And what you can see is that on the left-hand side here, there was actually only one period of time where the calendar year return was worse than what we've experienced year to date. And then that was in 1931, so in the depths of the Great Depression. This year it's down almost 22% for a balanced portfolio. This is U.S. investments, but not too dissimilar for Canadian investments. And what you can see is that the skew of this is really heavily focused on the left-hand side for 1931, 2022. But then you look at the range of returns and the range of outcomes that we've experienced pretty much in all years in between, and it's much more heavily skewed to the right-hand side. And in fact, the most common experience has been somewhere in and around 5% to 15% returns on a year-to-year basis. So when we look at this, it gives us pause to think about how impactful this year has been for investors and portfolios. But then when we look at 2023 and the likelihood of something like this happening again, it does seem fairly unlikely to us, or even further deterioration from here, it starts to look quite unlikely from that perspective. And then we look at bond returns. So this is the FTSE Canada long-term bond. So this is 6-month returns for each of those. And I split it up into recessionary periods versus non-recessionary periods. And what we can see is that the bond return that we experienced in the first half of 2022, that rapid sell-off in bonds, was actually the worst experience that we've had dating back to when this began, which was January 1970. So recessionary environment, non-recessionary environment. This has been the worst first half of the year for bonds. And again, it gives us this perspective of very painful, but there's a lot of things that would have to go wrong for that to occur once again. Certainly not impossible. Nothing's impossible, but for perspective, the more likely outcome is that we end up back in that median experience of between 0 and 5%, versus another year or another half a year where we end up with minus 22% returns. And the other part of this is that usually bonds are ballast in your portfolio. That's part of the reason you own them, is because when you own stocks, they tend to counteract each other. Unfortunately, this year, you can see with the star on the chart in the lower left-hand corner, that hasn't happened. Stocks have sold off, bonds have sold off, and bonds haven't provided that ballast because they've been so impacted by central banks raising rates really rapidly. So we took a look at this, and then we looked at an analysis of what's happened in the subsequent 6 months after we've had an experience like this. So it happens very infrequently. All of these, the red dots on the charts, show when we've had an experience of stocks declining and bonds declining. And in the 9 periods where this has happened, we've never actually ended up in that same quadrant again. We've never had a period where 6 months have experienced stock selling off, bond selling off, and then the subsequent 6 months have been stock selling off and bond selling off. So again, it doesn't help us for what has happened, but as we look forward, the likelihood of this occurring again starts to get slimmer and slimmer. So the question then becomes, is it possible we've seen peak fear in the bond market? Is it possible that bonds are starting to price in the rapid rise in interest rates and are starting to get more comfortable with the environment that we're in right now? And when we look at previous periods of rate tightening cycles, what we see is that the 2-year bond yields, which is the light blue line, and the 10-year bond yields, which is the beige colored line, they tend to peak prior to or right alongside the peak in the Fed funds rate. And that's what, right on the right-hand side of the chart, that's what this is showing you right now, is that bond yields have really surged in line with expectations for the Fed funds rate. And while it's possible we could see further changes in the Fed funds rate, we could see that increase quite a bit if we end up in that nightmare scenario where we end up in a recession, but inflation proves hard to tame. But if the Fed believes that the action that they're taking is strong enough, and the market believes that it is strong enough, it's possible we could be starting to approach the peak fear in the bond market, and that the volatility we've experienced in the past year may not actually come to pass in subsequent months. From an equity market perspective, that's fairly important. What we've seen historically is that bond yields tend to peak prior to equity markets bottoming. So the volatility that we've been experiencing in equity markets generally needs to see that fear abate in bond markets before they're able to achieve a sustainable bottom. So if it is possible that we've seen that peak fear occur, it's possible we could be entering this bottoming process for equity markets as we look forward. The only offsetting, or not the only, but one of the offsetting features to that is that we haven't actually seen a major adjustment in earnings. So typically we see about a 20% hit to earnings, corporate earnings growth during periods of recession, and we've actually seen year to date that the change in earnings has been slightly positive. There has been some adjustment in earnings, but when we look at the volatility and the sell-off that we've seen in markets this year, it's come purely from valuations as opposed to the adjustment in earnings. That doesn't necessarily mean we can't be forming this bottoming process in stocks. We think that markets are really starting to look forward and think about what the impact of a recessionary environment could be on corporate earnings. But it does give us a bit of pause and requires a bit more investigation to better understand what earnings can look like in the next year or so if we do end up in this recessionary environment. So the natural inclination then is to say, well, if we think that there's potential for more volatility, we think that we could be experiencing a recession, and we're uncertain about how much adjustment still needs to occur. Maybe I'm going to avoid equities in general right now. And I put together a couple of charts to talk you through that. This first one here, this looks at market performance both for Canada on the left-hand side and U.S. equity markets on the right-hand side, following inflation peaking, which we do think we're in the peaking process right now. It's possible inflation has peaked. And what we can see is dark blue lines, that's 3 months out, light blue lines, that's 6 months out, and the beige is 12 months out. What we see is that in subsequent periods of inflation, once inflation has peaked, we've seen equity markets tend to take off from there. So that tends to be a catalyst for equity markets to move forward in a positive direction. The other thing I will say is oftentimes people will say, well, if we're headed in for a recession, why should I remain invested right now? Shouldn't I get out and wait for everything to bottom and the economy to start to do better? But the market is a forward, especially equity markets, they're forward-looking mechanisms. And historically, what we've seen is that the equity market has bottomed about 3 to 4 months before GDP has bottomed. So well ahead of when that recession is actually here. And the average return that markets have experienced by the time GDP actually bottoms is around 20 to 25%. And then if investors then waited for GDP to start rising again, so not just wait for GDP to have bottomed out, but for it to actually start taking off, typically about 40% of the returns have been experienced at that point in time. So equity markets, the bottoming process tends to be very rapid, occurs very quickly, and it occurs well before a lot of people actually expect it to. And you can see that here in this chart. This looks at previous corrections and recessions and what's been experienced in markets when we've had these sorts of events, and the 1 month return from the market bottom. And you can see in each of these 15% returns, 12.5%, 27%, 25%. These are the returns that have happened in 1 month out of the market bottom. So the message with this is that if you're concerned about remaining invested in equities and concerned about the economic environment that may be presenting itself, trying to avoid equities and think that you have this ability to get back in is a pretty difficult position to be in, and you often see markets take off a lot more quickly than you would expect. And these are a major source of returns for investors, especially anyone who's experienced a lot of the volatility that we've had year to date. If you're missing out on these potential rapid 1 month returns that happen as the bottoming process occurs, you're missing out on a lot of the recovery in your portfolio, and that's how losses tend to occur. Is if you will try to avoid equities and try to time getting back in at a more advantageous point. So what I'll leave you with is this chart, which is I've mentioned how remaining invested in equities is important for investors, especially those who have already experienced the volatility that we've had year to date because of how quickly that bottoming process tends to occur. But if you're looking for more comfortable ways to remain invested in equities, dividend growth actually tends to be much more comfortable. So the left-hand side here, this is performance when of different types of stocks when volatility is above average. On the right-hand side, you've got performance when volatility is rising. And then each of these different buckets, you've got dividend growers, which is the dark blue lines, the TSX composite, so the general Canadian market, which is the light blue line, and then companies that don't pay a dividend, which is the beige colored line. And what you can see is that dividend growers tend to outperform on a 3-month basis, 6-month basis, 12-month basis when volatility is above average and when volatility is rising. So perhaps a more comfortable way of remaining invested in equities without trying to avoid timing the market or missing out on some of that recovery that can occur is by focusing on what it is you own in your portfolio and ensuring you've got a healthy number of companies that are able to grow their dividend and earnings over time and through multiple cycles. So I'm going to stop there. I thank you so much for your time today. I appreciate having the opportunity to speak with you, and I'm happy to take any questions that you may have for me.
All right, thanks, Krystyne. That was amazing. Here's Krystyne's extremely fun disclosure slide that she needs to show as well. And so she's managed to pull that off as well. So compliance is now super happy, and we're really happy to take any questions anyone has. So far, Krystyne, honestly, there's been not a lot of questions. I think you and I talked about before. We were looking at the markets and what we think about them. You know, it feels to me like we're forming that bottoming process at this point here in October and into November. And while you may not see all the recovery and the gains happen in 2022, simply because the year is almost over, we've also got next year as well and to grow. But I think your slide that shows that, you know, you want to stay invested, you want to stay in the market to some extent, rebalance perhaps at this point, but stay invested, because that when it does recover, it recovers quickly, and there's a lot of money to be made there. I think that was really telling. So You want to share a little bit of what you thought about the bottoming that we're seeing here? I think when you were talking to some of your colleagues, you shared that with me before the call, and then we've got some questions starting to come in now, which is awesome.
Yeah, absolutely. So in terms of the likelihood that the market is bottoming at this point in time, we've been going through our quarterly discussions around some of the risks and opportunities in markets yesterday and this morning, and talking through this and you know, a lot of the impacts and the fear and uncertainty that we've seen playing out in investor minds right now, and the Fed action is already translated into markets. And as I mentioned, typically you don't see equity markets bottom alongside GDP. You tend to see that occur beforehand. So we do think that it's possible we could be entering that bottoming process. It could be a period of consolidation. So we think of them as relief rallies, where you get, you know, a handful of days or weeks where you end up with more strength in the market and then perhaps a little bit more weakness. But it would really only take one or two catalysts to see the market sustainably create a bottoming process here and move onwards and upwards. And what I mean by that is, if all of a sudden we get a month or two of inflationary prints that are less than expected, less than the market expected, or if the Federal Reserve, when they come up with their announcement, they start to suggest that they're seeing signs of weakness in the economy, and the market starts to peel back on some of its rate hike expectations, we could end up experiencing a bit more strength. So the market is so data focused right now that even just one or two data points that start to suggest, hey, maybe things aren't as bad as we think they will be, or maybe a recession won't be as necessary or as deep as the market expects right now, could lead to that potential relief rally, or even sustainable bottom and move forward from here. So that's the conversation we're having right now. In terms of risks on the other side, the downside risk to that, it's hard to imagine how much more weakness we could get from a bond market perspective without seeing inflation continue to surge higher. And I'm not saying that's impossible, but all of a sudden we start to get base effects coming through. So the strength that we saw at this time last year in prices starts to become the new base, and it's hard to see prices really start to take off from these levels and get these higher and higher prints. So it seems unlikely that will start to occur, and that's helping form some of this thesis for the potential that we could be entering a bottoming process.
Hey, Per, I have a question,
Please,
and a comment. Okay, Krystyne. So my comment is, first of all, you know, the markets are emotional. I really discount markets altogether in their gyrations and look more at valuations, which I think are quite fair right now, probably more than fair. But you know, the people pulling the levers on interest rates are rational thinkers, and we would hope well-educated and based on experience over the last century, are not interested. I'm asking if you agree or disagree in creating a huge unemployment scenario or a huge recession in either the US or Canada, or in the world for that matter. So they are most interested in seeing a favorable outcome from extracting some of the surplus cash that they injected into the economy, and also this mismatch between job postings and available people to fill those positions, so that they don't get this whole wage price spiral. Would you agree with that?
Yeah, I would. It's part of their dual mandate. So if all of a sudden we start to see unemployment surge and really detrimental impacts on the economy, the Fed will be in a very tough position if inflation isn't under control at that point in time, because they're required. It's part of their job description that they have to maintain that balance. So that would be the really tough scenario, where they would have a decision to make between inflation, how much inflation they're willing to allow to happen, versus how much they're willing to allow damage to the economy to occur.
Okay.
Our expectation is that inflation will be easier to tame than perhaps the market thinks at this point. So we don't necessarily see that playing out. We think that the recession isn't going to be as deep as the past couple of recessions that we've seen occur, and that it may be of middling length, so it won't be quite as long as we saw during it definitely won't, or definitely, I shouldn't use that. We don't expect it to be as long as we saw in the aftermath of the financial crisis, nor as short as we saw in the aftermath of the COVID lockdowns. But that the action the Fed is taking today should be sufficient to get inflation more normalized, that they can start to institute what we like to call the Fed put, which is stepping in to help the economy and help the markets achieve more sustainable footing.
Okay, so my other observation or point is, and I respect the fact that you're an economics major or went to, you studied economics as did I. Inflation is measured on a year-over-year basis, correct? So if prices stay exactly where they are today on all fronts, oil and all the products that we purchase, into next year, and there's no change, what will the inflation number be?
It would be about zero.
It would be exactly. So we've had a run up of inflation due to oil prices, transportation costs, disruptions, and everything in this last 18 months, we'll say. And if they're not successful in reducing prices, if they stay stable, which they won't, they're going to come down anyways, then inflation next year will show as a zero number. And I think people have to appreciate that. It's not a decline, an increasing scale that every year over year you get this. So to me, this seems like a real battle about wage inflation. And what the governments in play are trying to do is try to put the lid on the demand for increased wages to compensate for this inflation right out the gate, so you don't get the spiral happening. And that's really what the shock has been all about. Anyway, that's my observation. Would you agree with that point?
Yeah, I would, and that's the base effects that I mentioned is where you're the base that you're coming off of as you're calculating CPI. And I would say that not that it's something that the Fed monitors religiously, but the break-even inflation rates, those expectations 2 years out and 10 years out, certainly plays a part in the inflation expectations that are embedded in markets as well. So they do keep a close eye on those and make sure that that's under control as well. It's an important function of ensuring that inflation doesn't end up in this wage price spiral.
Yeah, agreed. Okay, that's cool. So I mean, GDP going forward, if you look at Canadian numbers, because I know we were forced to see U.S. numbers, they're not forecasting a negative GDP year with this adjustment in interest rates, are they?
So the Federal Reserve isn't. RBC GAM is, and we're going through our process of releasing our new forecasts, and our expectation is that 2023, both in the U.S. and in Canada, will be a mildly negative print for the year.
Okay, well, we'll see how that plays out. That'll be interesting. All right, that's good. So, I mean, for my clients who are listening, the comment about dividend holdings is a big part of our portfolios and always been a part of our strategies. And we like to balance that out nicely with bond holdings and some other growth equity positions, but we do have a third, at least in most cases, in dividend stocks. And I think our sense is that the valuations certainly out there are fair at the rates they are now. So there is an opportunity in a rosier world for equity markets to increase just based on the current level of valuations after this correction that we've gone through. So all things being equal, it was a normal adjustment period after 3 really strong years. So we'll see how it plays out.
And just a note on that, Krystyne, I mean, speaking with your GAM colleagues and the fund managers, can you share maybe what the sentiment is on, I know there are different teams, but can you share a note as to, are the fund managers optimistic, pessimistic? What's the general sentiment that you're hearing in speaking with your colleagues as to the outlook and how their funds are being positioned?
Yes, absolutely. Well, they all agree. If there's one thing they all agree on, it's that it'd be really nice to know some certainty around inflation peaking to get that date, because that's where a lot of the risks start to abate is once they have that under control. In terms of taking risk positions in their portfolios, in general, sentiment was quite positive, and on the whole, they're more inclined to take risk in their portfolio now versus where they were 3 months ago and 6 months ago. So a little bit more optimistic from that standpoint. And as it relates to, we have overall asset mix and our balanced portfolios. The positioning that we've taken, we've done a number of tactical trades this year, trimming bonds, adding to and trimming equities as markets have moved a little bit. And we're sitting closer to neutral in our portfolios. But the most recent change that we made in our portfolios was to trim our bond holdings slightly and add to equities on some of the weakness that we experienced. So again, incrementally taking a little bit more risk in our portfolios.
Nice. Okay, good. Thanks. All right. Well,
so another question that's come in, Krystyne, thank you, is from Ramit, and I think this is a question that everybody's asking. When can we expect the Bank of Canada and the Federal Reserve to stop hiking rates? So soon is my answer. That's the answer I've got, and I think, if my expectation, I think I shared this with you before the call as well, is that next year I wouldn't be surprised towards the end of the year if we see them cutting rates, having probably raised rates too much. But they're human, and everybody makes mistakes. So I think that's currently where we're heading into, the mistake area.
Yeah, I would agree with that. Our expectation is that it's possible we see 1, maybe 2 more hikes into early next year, and then that will be enough for the markets to have adjusted and more inflation data to come in showing better signs of weakness in inflation. And Bank of Canada, they've been fairly aggressive. They've been more aggressive than the Federal Reserve has been. So their tightening cycle could end up a little bit sooner than the Federal Reserve, but we're still waiting and watching. It was interesting to see them only hike 50 basis points last week as opposed to the 75 basis points that the market was expected. So they're already starting to signal that perhaps they need to take their foot off the gas a little bit.
I think it's going to happen sooner than later. And I think, unfortunately, we're tied to this big elephant called the United States of America, and we have to protect our currency a little bit also. And that's sort of forcing their hand on rate hikes. When the dollar depreciates against the US dollar, it's great for our exports, but it's tough on our imports, and that's inflationary to us too. So, well, that was great. That was really interesting. Thank you.
Yeah, thank you very much for having me.
So thanks, everybody. I think we've hit kind of the 1 hour target that we were looking for. I know there were a few good questions that came in, and Krystyne, I think a lot of everybody that's watched it here has really enjoyed, your charts and your succinct, summary of what's going on in the world right now and where we think things are going. So once again, we thank you for spending the time with us and sharing your thoughts, because it's always been amazing. Thank you very much. And with that, on behalf of Jeff and Eric and to the team at RBC GAM and the team here at WWH Financial Group, want to thank you very much for joining us. We're looking forward to that bottoming process and the markets recovering. That is coming. Do not despair, and we look forward to the new year as well. So everybody have a great rest of your day and enjoy the sunshine.